Hi there, everyone. It's Sifty from Extreme Returns. For those of my regulars, you know what to do. I'm a chartered management accountant who's worked at world-class companies like Unilever and Mars Confectionery. I went into recruitment consulting and headhunting, and then after many years decided to set up my own business. Started with a successful estate agency, and then most recently, I've been doing car hire on a peer-to-peer basis on the Etoro and GetAround platforms. My family and I are the largest in the UK. I've made a fun video. Check out Iftiuddin, my story on YouTube. It's 1.5 minutes long. Enjoyed that. I've been featured on the BBC, in the Independent, Motoring News and Evening Standard, amongst other places. My channel is called Extreme Returns, so do please consider subscribing as well. I've only got 4 months of stats, but I've got a lifetime of experience. I'm currently studying the International Certificate of Wealth Management. I'm a chartered accountant already. I'll do the advanced one after that as well. So stats were 15% in February alone. They've gone down. The markets have tanked. They did the same in January as in double digits. I really want to get into double digits. 38 copiers. Thank you to all of them. 247 followers. What are you doing still following? Jump in. Best time when the markets are down. Today, I thought we'd cover a company in the portfolio called KERING, based in France. Market cap, 56 billion. Enterprise value, 62 billion. So just to recap, when the enterprise value is greater than the market cap, the company has net debt. Now, that's not surprising given what we've been through in the last year. So in the quality metrics, it's 81, value is 28, momentum is 17. So let's go through this in one moment in a bit more detail. But first of all, I just want to take you through the company. So KERING are a France-based luxury group, Paris-based. It owns a portfolio of fashion brands. And here they are: Saint Laurent, Gucci, Bottega Veneta, Alexander McQueen, and so on. I can't pronounce some of these. I won't do them justice. But they own fantastic luxury companies. And of course, they do all sorts of things. Their companies do leather goods, apparels, accessories, footwears, watches, jewelry, etc. for both men, women, and also children. And it's a global company. Let's have a look at their website very briefly. I like this website. Fun, isn't it? And it goes on. I'm not going to go through the whole thing, but they've got their brands are here, you can see. And it's great. So let's go back to their financials. Looking at their revenues, 2015 was 11.5 billion, went up to 12.3, went down in 2017 significantly by more than 15%, then shot back up again, and it's been going up and up. Obviously took a hit last year, and this year, I don't think they're going to hit those numbers because of the shutdowns. But next year, certainly, I think that number is very realistic. So the compound annual growth rate is only 2.5%. If you look at net profit, let me try and make it bigger. So net profit has been going up steadily. Look at this: 696, 814 in 2017, 1.7 billion euros. I'll round it up to 1.8. Then went up again significantly in 2018 to 3.7 billion. It's gone down since then, but still incredibly profitable. Now, the interesting thing here is if you look at net revenue, total revenue here, it's 2.49% compound annual growth rate. That's what CAGR means. That's just the average of the growth. In the net profit and also operating profit levels, it's significantly more. At net profit, it's over 25%. So what that means And this is one of the good things about having a luxury company in the portfolio. What that means is that every extra euro of revenue is significantly more in profit. And if you go down to the operating profit margin, it shows, I mean, there were only 11% in 2015, 2016, but look, their real or their underlying profit operating margin is significantly more than that, 23, 27, 29. And they're holding it even in the pandemic. Return on capital employed isn't so great. This has been going up and down quite a lot. So you see it 6.7% here, 7% here, 13, 25, 24, 15. So that, I think, is a measure of the fact that they've got a mixed strategy, both retail and through other distributors as well. Operating cash flow is an important metric, but I think the most important of all is free cash flow. Now, just to remind people, free cash flow is a measure of the amount of free cash available to a business after it has paid its operating costs and after the effect of capital expenditure. So when you do that per share, it's really interesting. Here, it's growing at 27.5% year on year. And that's taking into account that it was actually much better during the pandemic than even before. Mind you, it hasn't got back up to the 2018 level. I expect that to happen soon. This is an incredibly profitable business with high margins, and that's the reason I love it. Look at the dividends. On a per share basis, it's been going up by nearly 15% year on year. Obviously, it went down last year, but it's a reliable dividend. If you look at the dividend cover, now, what is dividend cover? It's a popular measure of dividend safety. So what that means is that the higher this number is, and it should be anything above 1, then it's okay. But here it's well over that level. It's sitting on, they're sitting on 3.6 billion euro of cash. I expect this company to really bounce back. Now, let's look at the share price. If you look at pre-pandemic, let's say up here, 483, say 500. It's only at 525 at the moment. It did go down as low as 357. It's a bit of a yo-yo stock. So you see it going down, going up, going down, and it went all the way up to 597 here, went down to 518, went up again to 620, and it's been going down steadily. I expect it to be well above its all-time high by the end of the year if we get back to normal, which I expect we do. PE ratio. Now, as you know, the PE ratio is probably the most common valuation ratio. What it means is, it stands for price earnings ratio. What it means is that the higher the number, the more expensive the stock. So 22.8, let's compare that with the market. So in America, this is the S&P 500, it's 21.2. The FTSE all share is 16. Hang Seng is 10 and Nikkei is 17. The Nasdaq, I think I can show you that one as well, is it's somewhere down here. Here we go, Nasdaq 100. So the Nasdaq is at PE ratio 33. So going back to Kering, you would expect companies, oh, that's not it. You would expect companies like Kering, who are luxury goods, to have higher PE ratios than the market. And I think it's quite cheap compared to other luxury goods. Dividend yield is 2%, which is reasonable. PEG ratio, the PEG ratio, is anything under 1 is really cheap. It's expensive upon that basis because it's taking into account growth. But all of these numbers I would take with a pinch of salt because of they've got 2020 numbers which aren't normal. But having said that, the relative strength towards the market. So if these are relative strength, simply means how is it compared to the rest of the market, and it's underperforming the market. And you'd probably expect that as well. If you consider lots of stocks have risen, the stay-at-home stocks or the pandemic stocks, this stock has been hit hard by the pandemic. Therefore, you'd expect it to be lagging the market. I expect all of those numbers to change significantly. Now, one of the things that I wanted to show you, I'm not going to go too much into the balance sheet, just other than to point out the fact that there is a fair amount of long-term debt, but it's at decent rates. But one thing I did want to show is the shareholders. Now, the largest shareholders, as you can see, are the Pinot family. Now, when you Google them, they are in all sorts of, they're one of the wealthiest families in Europe, in the world. Legendary investors involved in luxury goods for many generations. They are top notch in what they do. So the fact they've got 41% of a 56 billion market cap company with lots of luxury brands gives me a lot of comfort. Secondly, my favorite fund investment managers are Baillie Gifford. So I really follow them quite closely. James Anderson, Gary Robinson, Tom Slater, and all. They've got a big holding at 5%. Interestingly enough, the Norwegian Sovereign Wealth Fund, which is the largest in the world, has got a 1% holding in it as well. So that's a little bit about KERING. That's their website. Now, the other thing I just wanted to do is just go on to one of the other sites I subscribe to, and that is Seeking Alpha. Now, Seeking Alpha have got some really good articles. I just wanted to show you one of them. Market focus, here we go, KERING. So this is fairly recent. Gucci, it says, was a weak spot for KERING, despite the company's good overall financial performance, only a 1.2% year-on-year decline. KERING has a financial capacity to execute on mergers and acquisitions, which I think is really important, but there's no guarantee this will create value for shareholders. Most of the time that's true. In this example, I'd say they're in such a specialized field that I don't think they'll mess up. This guy says it's neutral, which means don't buy, don't hell, just keep it. Gucci brand was weak. He said that already. Established in 1963, KERING refers to itself as a global luxury group, which manages the development of a series of renowned houses in fashion, leather goods, jewelry, and watches. And here's some of their brands again. So that's a quick background about KERING. Let me see where they are. Here we go. It's showing as a loss. I have bought and sold it to rebalance it. I think this company will be one of the best performers in the portfolio over the next 12 months. That's me. Thank you very much. Quick plug for my wife, whose name is Adiba Uddin. She's been accepted as a cadet onto the Popular Investor Program. I'd be really grateful if you copy her. Her stats are reasonable, 3.61% in December and break even pretty much in January and February. It was actually double digits in January, double digits in February, and then the market tanked in both cases. But her focus is on China, Japan, South Korea, Taiwan, and the Far East, the Asian tigers. So Baidu, C, Meituan, Neo Technologies, JD, an ETF for Taiwan, Pinduoduo, and others as well. Some really good companies there. And this is an excellent time to start copying because the markets are in turmoil. I think that these funds, Asian Tigers, Extreme Returns, will deliver fantastic returns over the year. That's me. Thank you very much for joining. See you guys very soon. Take care and bye.